Hello there, this video is dedicated to a concept widely used not only in binary options trading but generally in trading. It is called a golden and dead cross. When such a pattern forms, then traders have an idea or an educated guess about what the market will do. Now I won't go into any other details. Now let's go straight into the problem, and this is the Euro US dollar and the 4 hours chart. Now the name is telling us everything. A cross, a golden cross, like it suggests, it's a bullish sign. Hence we need to buy, or we look to buy, call options. On the other hand, when the market forms a dead cross, a negative sign, then we need to buy put options. For a golden and dead cross, we need two moving averages. So on any trading platform, be it the MetaTrader or your platform as from the binary options broker, it is impossible not to have a moving average. So in this case, we go to find out the moving average. We go on indicators, add indicator, we go under the overlap studies here, and let's go and scroll down a bit. MA, moving average. On the MetaTrader, for example, you can find it on the trend indicators. Every trading platform has it. So a moving average, ideally you use the close price, but you can use an open price, high price, low, whatever. The classical one uses the close price, and here you have the possibilities for the MA type. What does it mean, the MA type? It means that you might have an exponential moving average like this one here, a weight moving average, or a simple moving average, an SMA or SMMA, whatever the type. I would suggest for an exponential moving average. The reason for that being that it cuts a bit from the lagging time until price reaches the moving average. For a golden or dead cross, we need two moving averages on the screen. One should have the period 50. What does it mean? It means that on the time frame, in our case is the 4 hours time frame, on the time frame it considers the previous 50 or the previous closing price of the previous 50 candles before plotting a value. You know, this is red line here, so this would be our EMA 50. We said add, and then we want to add another one, still on the same add indicator. We go on, we said overlap studies, let's go on the moving average, and then the second moving average that we need is a 200 one. The 200 one. In order to have an idea about which one is which one, then we have to add it a bit. We change the color simply. If the 50 is red, let's put this one in blue, and then we click add, and just like that we know that the one in a bullish trend, always the 50, the moving average 50, will be above. In a bearish trend, always the moving average, the bigger moving average would be the other way around. So a golden cross forms when the market goes and breaks the 50 moving average, go and moves above the 200. So this one here is called a golden cross. Now this is the Euro US dollar on the 4 hours chart, but the same principles can be used on any time frame, on any currency pair, golden cross, or on any financial product that you want to trade binary options with, be it a stock, be it a stock index, whatever. A golden cross. That cross forms when the moving average, the 50 moving average, let's go here, the 50 moving average, the red line, moves below the biggest one. Now that's called a dead cross. Of course, it's a bearish sign. Dead cross. It's a bearish sign. We only want to trade put options on a dead cross, and we only want to trade call options on a on a golden cross. Now there's a catch, because as you can see, the market doesn't always go in a straight line. You don't have to have always such a strong trend that will make easier to buy a binary option, and even in such a strong trend you may end up choosing the wrong expiration date. But the catch in binary options trading is both the striking price and the expiration date. But the expiration date must be adjusted to the time frame. So this is the 4 hours chart. If we take an option, or if we buy a euro US dollar call options, for example, on the 4 hour chart, it doesn't make any sense, any logic to have a 5-minute expiration date. But it will make sense to have an end of day expiration date, or maybe even end of week expiration date, or maybe even end of month expiration date. I have no problem waiting for a couple of weeks until the binary option broker pays me 70 or 80% or maybe even 90% rate of return on an option. Now, what's the catch? The catch is the following. These two averages represent support and resistance. They follow price. They represent support and resistance, dynamic ones. Namely, it's not a horizontal level, but a dynamic one. The idea is to filter the signals, because you will have plenty of fake signals, to filter the signals in two occasions or in two trades. The first two touches, that's all you need to trade when it comes to a golden cross. Imagine first of all how many currency pairs you have, how many time frames you have, and therefore how many other financial products you have, and therefore you have plenty of opportunities to trade binary options with the golden and death crosses. So let's go on, starting from here, from where the death cross forms. Now this was, if I remember exactly, right before the US presidential election, right here. So we have a death cross, the market forms a death cross here, and then goes and touches both the MA200 and the MA50. That's a very nice place to go short or to buy a put option. It's the first touch. Remember, we want to trade the first two kisses. So this is one time on the MA200. Always the MA200 plays more weight on the price action rather than the 50. So we want to trade the first two kisses on the MA200. That cross means a bearish market. We buy a put option. Another possibility to buy a put option would be right before the US presidential election. Now it depends very much. So this one here, regardless the expiration date, so being on a 4 hour chart, I don't know, end of week expiration date, end of month expiration date, end of week expiration date, end of month expiration date, this one definitely is a winning one. This one may or may not be, because this spike here happened right with the US presidential election, and then the market moved lower, so it could have been that it's a winner. But that's it, you trade only two. Now you might say, alright, how about this one? Was it a great place? Of course it was a great place, but the more the price has the ability to reach the MA200 more than 2 times, the weaker the trend becomes. That's a bullish sign in a bearish market. So you want to avoid it. How do you avoid it? Well, if you go and insist on trading a binary or a put option here, definitely do that with a lower risk, with a lower exposure. So here, if you trade a specific amount in your option, here, after already 2 kisses, if you want, after already 2 opportunities, here you trade only half a position if you want, or maybe a quarter of it, not to mention here. And then the market goes and forms a golden cross right here. It turned out it was a fake move, but it was a golden cross. Here, or from this moment on, we want to trade the first 2 times the market reaches the MA200, the blue line. One time is right here, the second time is right here. Thank you very much. 2 call options, perfect expiration date, expired in the money, so it came, bounced, came, bounced. That's where the money is. And then the market, like it or not, forms a dead cross here. Now this dead cross gives us, so that the dead cross is here, gives us the opportunity to trade a put option right here, to trade a put option right here, and then that's it. We don't trade this one anymore. If we still decide to trade this one, we should take it with a grain of salt. Look here for the third opportunity to go long. It may be, if you trade it at the end of the day, or maybe even trade a week, it may end up being profitable, but it's definitely a risky one. The ability or the price ability to come to the MA200 is showing bearish signs. You don't want to be long anymore. You don't want to buy call options anymore. Here, the ability for price to still push for the third time into the MA200 shows bullish conditions. Needless to say, the market forms a bullish cross here, or a golden cross here. And the bear, so here let's go with the analysis. It forms a golden cross here. We want to buy a call options when the market comes to hit the MA200. So we go and buy a call option here. Now this one expires out of the money. The market goes and forms a put option here, a death cross. We want to buy put options, so we buy a put option here. This one expires in the money probably because we have here something like 20 candles times 4 hours, plenty of time to expire in the money, and then forms a golden cross with the opportunity to buy a call option. The first one, remember, the first 2 times it reaches the MA200. The first 2 times, this is 1 time, perfect trade, and another one would be when the market reaches the MA200. Not here, not now, not in this very instance. Now let's go back for reviewing this strategy. So we have what? We have one option that expires in the money. 1, 2, 3, 4, 5, 6. This one is a losing one, so one losing one. Let's say a losing one, but it could have expired in the money. So 6, 7 in the money, 2 out of the money, 8 in the money. Now with 8 options in the money and 2 out of the money in the last 6 months, do the same process on the 5-minute chart, on the hourly chart, on all the currency pairs that you have, and on other financial products offered for binary options trading, and you'll have a very good understanding of what powerful a golden cross and a death cross is in binary options trading. Next we'll move with Elliott Way's theory. We'll make a series of 4 or 5 videos explaining the concept and the importance of waves in binary options trading. Thank you for being here. Bye bye.